So, few things. Biden signs spending bill into law. President Joe Biden signed the spending bill, officially called H.R. 5860, into law late Saturday night, preventing a government shutdown. So, the government has finally gotten this out of the way. The market was concerned about risks of a government shutdown, but Biden right here, really puts away those concerns for at least another 45 days. So, that is a bullish catalyst here that could be hitting the market as soon as the open, excuse me, next week. I just wanted to start off with this article because I think that is pretty important here. It happened on the night, as I said, late Saturday night. So just going back to the chart here, we have our NASDAQ chart. Let me get rid of this Bollinger Band. So on our NASDAQ chart, our last update, we were at these levels down here, right around 14,500. I actually made a video right when we were bottoming that very morning down here at those levels. Actually, it was right here when we were getting this little inverse head and shoulders. And I called for a return to the gap fill, which is still sitting at around that 15,000 area, or to gap resistance right here at 14,848. So let me just move down to an hourly chart. As you can see, we were correct in predicting the rally. We rallied up right to gap resistance here. We came right to the critical zone, and we've turned off of the critical zone here. Now, we have gotten a slight equal low or a higher low. If I just pull up a MACD to see what's going on around this level with the moving averages, as you can see here, we do have a divergence that formed on the hourly time frame here for NASDAQ. But if I switch over to the 4-hour time frame, we don't have a divergence yet. Now, we don't always get divergences, but the fact that we took out this level right here, taking out that potential bullish divergence that could have formed, as you can see, we made new lows on the market and on the NASDAQ and on the indicator, excuse me. So, maybe we rally up a little bit more here before, crashing down in a final fifth wave and getting the divergence on the 4-hour chart. Now, simple divergences on the 4-hour chart, they're pretty powerful. If I go back in history, as you can see, we had one right here. It was just a simple divergence between the lows on Thursday, March 2nd and Thursday, March 13th. So, 11 days apart, we still crashed down and in a capitulation type move here, aggressive sell to the downside, well, obviously. Before getting this little simple divergence on the 4-hour time frame and rallying up, getting a massive rally here. Let me just pull up our moving averages. As you can see, we broke the moving averages, broke all of this stuff, but you always want to be looking for moving averages that form, for divergences that form under support areas. So let's say if you're breaking under these moving averages, you want to look for the divergence that forms right under that. Like even if we have this trend line, let's say we came here, got a higher low, but the indicator made a lower low. We would be making a divergence under this trend line, this accelerated trend line here, which would probably tell us, okay, we're probably going to get a very bullish move here to come back into this channel and, throw it over. But, for now, we haven't gotten that, and we're still looking for a divergence to form on the 4-hour time frame here for NASDAQ. Let me just switch over to S&P. It is the exact same thing. We don't yet have the divergence here on S&P. Now, S&P on the 4-hour time frame does already have the divergence with the lows from March. So, that's pretty big. NASDAQ does not have it yet. It even has it with the lows from all the way down here in December of 2022. So, we're approaching the area where markets could bounce. We could get a divergence between the S&P and the NASDAQ, where S&P doesn't move to a lower low, but NASDAQ does in this crash wave 5, because I do think NASDAQ has a 3-3-5 pattern developing here for a flat correction. And that should take us to around this area right here, this little box that I have drawn out. So let's just zoom in a little bit more to the 4-hour time frame. The fifth wave that I'm talking about right here. Let me just grab a little pattern, Elliott wave impulse. As you can see, we're getting this 1, 2, 3, 4, and then we could get 5 here, crash down in one last capitulation type move down to this lower trend line. This is the very bottom parallel channel line to the top here. What we're bouncing off currently is this level. If I show it to you on the daily time frame, it is the level not on the candles, but on the actual close. So you can see if I switch over to a line chart, that is the level that we're bouncing off of in, with the shadows and with the candles here. So we're going to be looking. I still do think that we could get a fifth wave down to this level. If that was the bottom, then that is the bottom. As I told you earlier, last update, this is what? This is, we got a doji here, which could be a reversal or continuation candlestick. So we are watching to see what happens surrounding this level, We could come up here, rally, sell. It could get a little bit choppy inside of this area, but I don't expect us to, really start the big crash right now. I currently believe that, there's still room for upside. The Fed hasn't paused interest rates yet. And, this trend line is wrong here. It moved on me, I think. But they haven't paused yet. The rates are still going up. Then we're going to get a time where, interest rates should remain level for a little bit of time. And in past history, the market has rallied during those times. So I don't see why we couldn't, break this all-time high and go a lot higher. Nothing is stopping us from doing it. If we, once again, go take a look at the PCC and PCCE, which are the put to call ratios. As you can see, the PCC dropped a little bit there on Friday, but Thursday we got a peak above the last peak there. And I think we got the same thing on the PCCE. Okay, we got the peak on PCCE Wednesday, and we got it on the PCC the next day there on Thursday. But as you can see, we're starting to spike, and that could be, telling us that we're going to get this bottom here pretty soon. So be on the lookout for that. Now, the next thing I wanted to show you guys was just take a look at junk bonds. Once again, we're going through our indicators. We're going to take a look at junk bonds versus S&P 500 here. Put it in a new pane. Let me get rid of this little MACD. So as you can see here, junk bonds. What do we have? We have, a few divergences on junk bonds. We're making new lows below the lows from May. S&P is far from that level. So we are getting the positive divergence here between junk bonds and S&P. If I now go and take a look at the Dow Jones, the industrials versus the transports, as you can see, as you know, that is the Dow theory. Let me just pull it up here. Did I do that right? I did not do that right. Take them off. Excuse me here. So I'm just showing you this because, it is important to kind of stack your bullish signs. You don't just want to go off of one divergence on the MACD or on the RSI. You want to have a broad idea of why these moves could happen. And right now, everybody is bearish. When I go on Twitter, every single analyst is bearish, talking about the crash has started, and only a few people are still bullish here and there. The sentiment surveys are just absolutely bearish. As you can see, the PCC and the PCCE spiking recently. These are all signs telling us that people are getting a little bit too bearish, and that might not be warranted at this point right now in the market. Do I think we're going to get a big crash very soon? Absolutely. Do I think that is going to happen right now? I don't think so. So as you can see, we have the transports versus the actual Dow here. We're getting another, are we getting the divergence? We're getting a slight little divergence. Nothing crazy. We are getting a slight divergence here on Dow theory between the lows from June and the lows we're making right now. We did not make a new low, but we have made a new low on the industrials. Transports is bouncing off of that 200-day moving average. So once again, levels of support here that we're approaching as everybody is turning bearish. And once again, if we do come here and crash for the fifth wave in our 335, if we come down here and crash, everybody is going to be bearish. No one is going to be buying the market here or right here or wherever we might go right here. If we break this line, come back, retest it, start selling, people are going to go, oh no, we're about to, here we go. And then at that point, that's when, higher low, start getting above here, start going a little bit sideways for a while. Everybody gets bearish, put starts, pouring into the market, and then we rise up, maybe correct here, break the bull flag, and then continue up to new highs. I believe that we are going to make new highs. And my reason for believing that is that we've been going pretty much sideways here in our correction. We haven't gotten a massive crash like right here. As you can see, this crash just started immediately going super, super strong. But, we did get this kind of little first wave. So if this was our first wave, and, I am still open-minded to this happening, in which case I will turn bearish. If the signs tell me that it's time to turn bearish, then I'll turn bearish. No problem. I just want to be on the right side of the trend. I am only interested in being right. That is what Jesse Livermore says, in his book. I don't know if you've read Reminiscences of a Stock Operator. Amazing book that I recommend. But anyway, I digress. Let me get back to the market. So as you can see, we came up to a 78.6, and that is a level where we expect some sort of either correction or a reversal for this entire move down here. But here we breached it a little bit, tried to get above it, came back, retested it, tried to turn it into support, and then, crashed below it, came back up to it, and then it turned into resistance. And for now, that remains resistance. That remains our critical zone here. This is our first critical zone, and this is our second critical zone. If we can break through these two critical zones, then, the market is going up to where I think we could even hit something crazy like a 20,000 here on the NASDAQ to really turn everybody and their mom bullish. But for now, that hasn't happened yet. The facts are right now, we speak through facts here. So the facts right now are that we've found rejection at the 78.6, which is bearish. We did get above it a little bit, which is bullish. But if we can bounce off of the bottom of this this bull flag here, break it and retest it, and then continue up higher, we are absolutely going to go above this high. I can almost guarantee it. And, I think we'll go a little bit higher and then start the real crash. We'll get a real leg down at some point. Something that's not going to look like this, but something, pretty violent, like one of these. If I just go back to, for example, what is this? Let me see. Let me try going back to 2008 here, just to show you guys what I'm talking about. When you get that first leg down, usually, you're going to notice it. So this is 2008. The crash that started here October 2007 on NASDAQ. So look at this. Look at this day. 2.92%. Okay, that wasn't that crazy. But as you can see, we got a first leg down, went sideways. We got under the 50. Okay, we got under the 50, and then we found rejection at the 50. This is not what we're getting right now. Here we got under the 50, like we did right now. And then look what happened. We bounced off the 200, and then we went to make new highs here. The rally from bottom to top was something massive. It's 23%. So, I think that we can still get something like this before the crash happens to really, put the peak in on the market after the yield curve has inverted, because the economic cycle is most usually stock market top, inverted yield curve, and then stock market top. This time we got it. We got the inversion after the stock market top back in, last year, beginning of 2022. So I still think that there's very possible that we go to new highs. And from here, we could still rally like another 20-30%, in my opinion, here to really put the peak in. So yeah, what else did I want to talk to you about? That's pretty much it. Sequence counts, I had it in here. We do have a 9 count that developed here on the markets. We are going a little bit lower. I think it was right here. We are going a little bit lower here. That is why I think that if we get one more leg down, there is a real possibility. And I'm stressing this because I think this is the play to make. When everybody turns bearish here, they're already all turning bearish here. They think this is a, whatever bearish candlestick, and we're just going to crash here. But I think we're going to crash, scare everybody, get maybe like a big day. Maybe like we crash here, rebound, for a few days, and then get another big 3-4% day, down, kind of like we did right here. These kinds of days are, where they trap everybody. You want to be looking for a higher low if we get it right now, or if we go lower, rally, and then get it. That could be a sign of a big bottom coming in here on the market.